Hi, thanks for tuning in. I was asked today by Aaron if I could have a look at the S&P 500 monthly chart and analyse the last bar, the current bar, which is the bar for January. It's not yet complete. There's still 2 days trading to come, but it's close to complete. This might be my last chance to do some new videos for a little while, so I'm taking the opportunity to do so now. What we have is a reduced spread up bar on low volume. Still 2 days trading to go, so volume will increase a little, but it looks like it's going to be below average volume. Now, I wouldn't generally analyse the last bar in isolation. I would generally go back and look at the last significant point on the chart and then form a narrative back to the most recent bar. And hopefully that narrative gives you some idea of what might have happened. And that's because the most recent bar will reflect what's happened in the most recent past. So I would normally go back to a significant level on the chart and work my way forward, building a narrative using VSA principles to connect each bar together and build up that narrative. So for me, here, price broke down. Now, on this bar in particular, the market was certainly reluctant to break down. It attempted to go lower, but it did recover and closed back at this level. And this is the level I've chosen because I can see on the chart, the market has come back to this level more than once in the past. So I can see this is probably a significant level. If I just go back, initially, this bar here has the higher volume, and I would mark that as the lows of the range to start with. But subsequent trading says that this is actually the lows of the range. So I've switched to use that. Okay, so we'll mark that in as the lows of the range, and we can see that this bar attempted to break down, but the market was strong enough to recover and attempt to hold on right at the level. And it's certainly vulnerable, but it held on. But the next bar is the breakdown bar, and price moved lower on an increase in volume. Now, at the time, you may expect this market will continue lower if this was all selling. But the next bar was up in response, and it closed back at the highs of the range. So that leads you to think this was a buying bar. It may not have been a buying bar originally, but buying has come in at the lows of the bar down here. And then in response, the market has bought the offer back up to the highs of the range. This is the breakdown line now, but this is the old range. So what we have is a breakdown that's found support, and the market has pushed back up to the highs of the trading range, or the old breakdown line, which is always a significant level. The next bar, the market attempted to move higher, most likely in response to the buying that took place in the market previously here, because there was no sellers left, they'd just been taken out. It was easy for the market to go higher, but the lower volume tells you there's no support for the upside. And instead, the market comes back and heads lower. Now, if this market was about to just rocket higher, you would expect that the price would have closed back up here. But it didn't. It closed all the way down here. So that gives you some inference the market may choose to go lower. And it did. Doesn't mean it will, but there was more chance. Because it closed lower, there was more chance it would go lower. If it was going to rocket higher immediately, you would have expected price to close back at or very close to that old breakdown line, but it didn't. You can see that there's still enthusiasm in the market because it did attempt to push higher on this bar initially, but then the market slammed down. Interestingly, it didn't close hardly below the lows of this bar at all, despite there being very high volume. Volume increased considerably. But if that was all selling and all the buying in here was going to be dumped, once again, you'd expect the market to go lower. But what actually happened was a little mini shakeout and then a push higher. And then in response to that, a test for supply and another push higher. So what's happened here? The lows of the range here have been tested for strength. Now, it doesn't matter whether this was done deliberately or it was engineered by the active professionals in the market, or if it was a natural occurrence and organically the market headed lower, but buying support came in and pushed it back higher. That doesn't matter. What matters is what actually happened. And it was probably a combination of both, to be honest. And what actually happened was the strength of these lows were tested. If they were vulnerable, the market probably would have continued lower. But buying supports come in, the market's pushed back up, then tested for supply on the next bar and pushed back up to the old breakdown line or the highs of the new range. This is buying again. This is buying support. You've had buying support here. You've had buying support here. It's come in two halves. Let's have a look. Put the range in again. You've had two halves. It's here and here. This is buying supports come in. Here's the lows of the range. The market wasn't able to go below it. You've had increased volume on both down bars, and then you've had up bars in response both times. And the up bars have reduced volume because anyone who was going to sell was taken out on the down bar as price swept lower. So there's a supply vacuum temporarily within the range of those bars. As price moves higher, there's not so much supply in there anymore, so price can move higher with relative ease. So now we've got price back at the highs of the range or the old breakdown line, which is always a significant level. And price pulls back in December, once again on an increase in volume, but a much reduced amount of volume, and spread has narrowed considerably. It's still a fraction above average, but price has really only got to the halfway mark of this overall range. So this is a reduced spread bar on average or slightly above average volume. And the only way the market can have a reduced spread on an increase in volume is if buyers have come in. Buyers have come in and they've stopped the market slicing lower and stretching down to find buying support. They didn't have to stretch down. The buyers were there waiting. The buyers moved in and they kept the spread narrow. And then this month, to confirm the buying in the previous bar, prices moved higher, volumes lower, because it's trading within the range of the previous bar as an inside bar, and price swept lower, took out any supply in this level as it moved lower. So now it can move higher with relative ease. So we've got buying support, a little bit of over-enthusiasm here and here, but that's okay. In some respects, that's only confirming the buying that took place at this level. So putting it all into some context, if we've got buying support through here, this bar has moved up to the highs of the range with a reduced spread and volume because it's travelling in a supply vacuum created by the previous bar, which moved lower but drew out increased support. Now, what will happen in response? Generally, this being an index and not a individual stock or currency, it's not common for it just to slice higher unless there's some sort of catalyst. Normally the market will move sideways and it will trade in a range waiting for that catalyst to emerge. And then when the catalyst does emerge, price accelerates higher. Now, 50% of the time, it will come back and test the breakout for strength before it does move higher, and 50% of the time, it'll accelerate higher. There may be a little bit of shallow testing, and then it just continues higher again. But at this point, this appears to be buying support. Buying support's come in following this breakdown, and there's been some form of accumulation taking place through here. Most likely organic, but there may be some engineering in there as well by the professionals in the market. I expect it will take some form of catalyst for price to break out. And if you look back at one of my videos, there's always a concern during an accumulation phase that if something goes wrong, the positions in here can all be dumped. And because there's been so much buying built up in here, if they're dumped, a widespread down bar is created in response, and that's your telltale sign that the market has sold off and broken down. Widespread down bar on very high volume. While price remains above the lows of this range in here, then the positions are being held. There may be ongoing accumulation, but that's mostly because there is no catalyst for price to move higher yet. Generally, a big index will need some form of catalyst to move higher. Now, that might be the Fed reducing interest rates. There may be some other catalyst that emerges, but there'll be a catalyst, and on that catalyst, price will attempt to break out. It could fail on the breakout. It could come back and test the old breakout line for strength. But I think the narrative suggests that there is buying support in the background of the chart throughout this level, and now we wait to see if the market can prove that and confirm it by accelerating higher. But just beware that these positions could be dumped if the market changes its sentiment for any reason. It's always vulnerable at this level, and I've made a video on how the market is vulnerable during an accumulation phase. So if you need some more information on that, you can go back and look at it. But that's how I see it at the moment. Okay, hopefully that made some sense. Thanks for your time. See ya.